Well, cool. Well, it's 5 p.m., so we can get started. Don't want to keep anyone waiting. Thank you all for coming out today, especially with your busy schedules and trying to get back into the swing of things with the holidays. Hope everyone had a great Thanksgiving. I know that it's great to get going again and learn something new about taxes to prepare for, this upcoming April, and hopefully we're, ahead of the game on that. I This meeting started after Kevin and I had lunch, and he was actually giving me some information and trying to educate me about some things. And I wanted to share this with you all and other investors. And Kevin was gracious enough to take time out of his day and put a presentation together, make this happen, and not just doing one webinar but three. So this is the first one of three, and it's more of an introduction today. But the others will dive into more short-term rentals and into a little bit deeper into some of the strategies that we'll talk about today. To introduce myself, I'm Eric DiNardo. I'm with the FI team at eXp Realty. I'm a house hacker, a investor-friendly realtor, a new father, and just super excited to this will be a learning experience for me. So I'm going to be learning as much as you guys. And again, thanks Kevin for really putting his time into this and teaching us or learning something new today. Again, this is the first of the webinar series about uh, using tax strategies with real estate. And this is more, like it says, a foundation to some of the tax benefits. The next meeting, we will dive into depreciation. And then the final meeting will be about short-term rentals. Each one will be on Monday at 6 p.m. in the evening. And yeah, super excited to kick this off. So thanks, Kevin. Why don't you move forward and I'll be quiet.
for, for these at least the first of three presentations. I think they're all going to be pretty good and informative in the real estate space, which is very convoluted. And I guess, Eric, are we still able to see my screen here?
I can see it. Yeah,
Okay,
we're good.
awesome. Cool. Let's get going then. Um, let's see. All right. So who is this guy that's presenting to you right now? My name's Kevin Bevillard. I'm a husband, a snowboarder, cyclist, some other stuff, but of course, I'm also a CPA. I focus in the area of taxation mainly for real estate in terms of anyone that owns rental real estate properties, fix and flips, funds, and as well as anyone that owns a mid to small size business. Similar to Eric, I am a house hacker, remodeler, property manager. My wife and I, we got in the rental space in 2020, I think. And we own a few in and out of state properties. We've done midterm, short term, long term, burst strategy. Currently about to do a potential flip. So kind of have my hands in it from the ground up, I like to think, and then also the taxation piece as well. I can't remember if Eric said this, but I'm going to go through this presentation, and then at the end, you guys can fire off. We'll have a little Q&A session too. So make sure we make it through the presentation first, throw an avalanche of information your way, and then feel free to ask any questions. So we already went over who is this guy, who aren't I? I am not a lawyer, hence I am not your lawyer. I'm also not a CFP or CFA, so I do not give financial advice, and this entire presentation is for educational purposes only. All right, so going over our topics for the day, planning and bookkeeping, kind of the foundation of everything, active versus passive income and losses. This is kind of the crux of everything in terms of the real estate space for your taxes and the most misunderstood space. Depreciation 101, real estate professional status, and we'll kind of touch on some other status points, key deductions. Well, okay. Well, those are our topics. Let me see. Yeah, that's everything. All right. Tax planning and bookkeeping. So, believe it or not, planning is a crucial part in real estate, whether it's your first house or it's your 50th house. And we'll go through a lot of specifics on why that is. My number one and number two piece of advice is to talk to a CPA that's in the real estate space as you're buying a property or even before you're even under contract. They can help you walk through what to expect in terms of the tax side, how to get everything set up properly so that you can maximize your returns in terms of your tax return when that time comes around. There's a ton of strategies with real estate, especially real estate taxation. There's a ton of strategies. So, talking to someone beforehand is crucial, in my opinion. I've seen clients come to me after the fact. The whole tax year comes and goes. They do a property, they do all these great things and are expecting a huge loss against their W 2 income. And they tell me the fact pattern can't do it because it just isn't allowed. And they were kind of maybe fed misinformation or didn't even have the information to begin with. So, talking to a CPA, I'm going to harp that over and over again. If you haven't already and you're in the real estate space, bookkeeping is priority number one as well. If you don't have if you have bad record keeping, you're going to have a bad tax return or an inaccurate tax return. So having some sort of tracking system, even if it's Excel, is very important. Annual tax saving arbitrage, timing your purchases. We'll kind of dive into that a little bit more. But again, going back to talking to a CPA, if a CPA understands the real estate space and understands your fact pattern, you can do some arbitrage strategies with real estate to really juice up expenses in one year in which you can take those expenses to offset your W-2 income. And then maybe in subsequent years, dial it down when you don't need that big loss. Make sure to keep track of, during tax time, are you getting your filings done on time? Again, goes back to talk to a CPA. And then year-end planning too. The real estate piece is only a piece of your return. You have so many other things going on, and all those things could interact with the real estate side of income or losses. So real estate can be a large piece of your return. It is not the entire pie, though. I kind of just like this. You've probably seen this quote on Instagram or something, and I find it funny. So the next topic, active versus passive income and losses. Can my rental losses offset my W-2 income? That's probably like the most common question I get from people that are new to the real estate space. And the typical tax answer is it depends. In the real estate, if you're a W-2 employee and you have real estate, you want to think of two lanes or two buckets. Your active income is your W-2 income and or income from a trade or business. For whatever reason, and I won't go into that reason, the IRS determined a long time ago that rental real estate is passive income. Active income and passive losses cannot offset one another, generally speaking. And there's some exceptions right here. Active participant, real estate professional status, and short-term rental. These are the three common exceptions to this general rule where your losses from your real estate could cross over and offset your W-2 or your active trader business if you're self-employed. Okay, standards of involvement according to IRS rules. So these are the four buckets I like to think about, or four categories for real estate. The first one is passive. As I previously mentioned, rental real estate is generally considered passive income or losses, tracked separately from your active W-2 or self-employed income. Again, when it falls in this general bucket, they do not cross one another. So a loss from real estate If you're falling under the default rules, does not cross over and decrease your W-2 unless you can hit one of these three exceptions. The first one, active participant. This is if your AGI or adjusted gross income is below 150 grand, you might be able to take some losses from your long-term rental against your W-2 income. Those losses are capped at $25,000 if your AGI is under 100 grand. So it's this kind of like it's this phase out. If your AGI, and for all intents and purposes, we'll just call it W-2 income, a little bit simpler to explain. But if your W-2 is under 100 grand, you could generate up to a $25,000 loss to offset that $100,000. Once you cross over and you go in between 100 or 150 grand in W-2 income or AGI, that 25K loss limitation decreases $1 for every $2 you're above 100,000. So it's like a 2-for-1 phase out on that 25K loss limitation. And this 25K loss limitation is per tax return, not per taxpayer. So if you filed a joint tax return, it's a bummer because you're still subject to this phase out, and now you're combining two incomes into one. Generally, it's pretty difficult to get that full 25 grand when you're filing married jointly. The next one, which we'll go over in detail on this slide deck, is real estate professional, or you'll see me say or write out reps. You basically have to work full time in real estate and materially participate in your rental property. We'll go over those details later. The last one is short-term rental. If you have an Airbnb, is the easiest thing to think about, and the average guest stay is 7 days or less, and you materially participate in that property, you could have as many losses as you want to offset your W-2 income. That the short-term rental, I believe, is our last presentation. All of these presentations tie together a little bit, so it's not a huge deal if you miss one or you jump into this one and the last one. Not a big deal, but they do kind of cross over and help explain all the topics. And then if you're really bored and want to read some IRS publications, it is. All right, depreciation 101. Again, this is an overview. We have the next presentation a week from today will be in depth on depreciation, cost segregation studies, et cetera, et cetera. But depreciation is the great mover in terms of your tax return a lot of times when it comes to real estate. This is a more of a tax rule or a tax kind of a phantom deduction or a ghost deduction, I sometimes like to call it, because when you do your bookkeeping, you generally speaking won't record depreciation throughout the year equal to what it would be for tax / you probably won't record it at all, period. So this is a deduction the IRS gives you for your property. In theory, it's wear and tear. It's a ghost deduction. It's not going to be on your books, but it'll be on your tax return. And this is where you juice up your losses a lot of times in real estate to offset your W-2 income. The first one, oh man, keep on clicking on stuff here. The first one is Internal Revenue Code 179. Not terribly common to see for multiple reasons in rental real estate. And the biggest one is because a 179 deduction cannot increase or bring you into a loss. So it's very uncommon for me to see this. I have seen it taken incorrectly before on if I pick up a client, I've seen a CPA do it where they take 179 when they didn't have to. They could have taken bonus. Bonus depreciation is an accelerated form of depreciation. So similar to 179, it is a way to juice up your depreciation, which increases your losses. It's called bonus depreciation because in addition to your regular depreciation, basically, I think it was in the early 2000s they came up with this. I believe it was after 9/11, and they did it to stimulate the economy because they figured if they could give taxpayers a very large year one deduction on their return via bonus depreciation, they would go out and buy assets, whether that's real estate, whether that's trucks, equipment, laptops, that kind of stuff. And it's a form to stimulate the economy. People spend more money because they're getting a return on their tax return via bonus depreciation. Um, it can only be taken on certain properties, so it's not on everything. Again, we'll get into that in more detail on the second presentation, but here are the current enacted bonus depreciation rates. And I put an asterisk next to 2025 and 2026. As you may or may not be aware, I think the 4th of July, they passed the OBBBA and it brought back 100% bonus depreciation. So that's a huge win for real estate investors on this one topic, but there are certain stipulations with that you have to meet to get bonus depreciation. Um, the next kind of tranche of so you have three tranches kind of is 179 bonus depreciation, and then you have your regular makers. It's modified accelerated cost recovery system depreciation. This is kind of like your regular tax depreciation. If you didn't want to accelerate depreciation, you just follow this standard rule. And basically, all the rules is outlined in publication 946. It's this 100 and something page publication that goes over how the IRS defines every asset and how to depreciate that for tax purposes. And it's not as simple as you think. It's pretty complicated. One of the most complicated sections in the Internal Revenue Code, in my opinion. But yeah, it's the great tax saver. One thing to be aware of with it is a tax deferral method in most instances. It is not a permanent tax benefit. By taking depreciation in one year, if and when you sell that property, you could owe, if you sell it again, taxes back to the IRS at ordinary rates. Everyone thinks that when you sell an asset and you hold it for over a year, it's going to be taxed at those preferential capital gains rates. If you took depreciation on that asset, that may not be the case. You first have to look at how much depreciation you took on that asset in all prior years and compare that to your gain. And that's called depreciation recapture because a portion of that gain could be recaptured and taxed at ordinary tax rates. This little segment right here is kind of just a good quick explanation, but of depreciation recapture. And if I kind of didn't harp on the point, all depreciation is, again, is you're writing off the basis. So if you have a $500,000 house, the IRS prescribes different methods and conventions and lives for how you should decrease that basis over time. It's basically saying, hey, this property is being used for wear and tear. We understand that. For rental real estate residential property, they say you can write it off over 27 and a half years generally. So 500,000 divided by 27 and a half gives you your baseline depreciation. Okay, real estate professional status, probably my least favorite thing in the world. It is probably the most talked about thing with clients of if they can be a real estate professional. It is a wonderful strategy if you are in the real estate space and you have, let's say, a spouse who works a W-2, you're a real estate agent, you qualify for real estate professional status, and you have rental properties that you materially participate in. You are now a real estate professional, and all your losses from those rental properties can offset your income as a real estate agent and or your wife's or your husband's W-2 income. So reps is a great strategy for high income earners with a W-2 and then another partner that's a real estate professional, and they have rental real estate. Um, who is a real estate professional? The IRS defines this as 11 trades or businesses. I'm not going to read them all, but it's basically like think real estate agent or builder or remodeler, that kind of stuff. Can I be the common question is, can I be a realtor on the side and work a W-2 job? Absolutely not. We'll get into that in a minute. You have to be full-time in real estate. Um, Another question I get is, do I still have to manage my rentals to claim the losses? Yes. Essentially, we'll get into what material, I keep on saying material participation. We'll get into that, I think, more on the third presentation, but you have to essentially be the property manager. You have to do almost everything for each property for it to qualify. Um, do I qualify for reps if I'm a W-2 employee for someone else, but work in one of the 11 industries above? Yes, but you have to be at least a 5% owner of that business that is paying you a W-2. Seen that a couple times. So if you work a full-time job and you're trying and it's not in one of those industries and you're not a 5% owner, don't even try to claim it. I kind of want, I'll just touch on some of this stuff, but so reps qualifications, you have to spend at least 750 personal service hours in a real property trade or business. Again, if there's 11 uh, businesses on the prior slide, and you must spend at least more than half your time as a real estate professional. This is why no W-2 employee that works as an advertising specialist or an engineer and has rental properties will ever qualify, because effectively you're going to have to prove out that you work more in real estate than you do your engineering gig. And a full-time job is generally 2,000 hours a year. So now you're going to have to prove every year, every week of the year, you work about 77 hours. And somehow more than half of that has to be in real estate. Uh, there's a lot of court cases on this. Not a single person has won. Well, that's a lie. One person has won their court case, but he was a part-time deep sea fisherman and it was seasonal. So that was just kind of rare. And again, you have to materially participate in those properties for them to get dumped into your reps bucket. Essentially, self-management. There is a grouping election in there, but that's like, yeah, that's more in depth. Reps example. So here's a quick example. Gunner has a property management company he owns and operates as his full-time gig. He spends 1,800 hours being a property manager in a year for other people's properties. He also has a long-term rental that he spent 110 hours on, and nobody spent more time on that property than him. Gunner made 150 grand from his property management business, and he had a $20,000 loss. Does Gunner qualify as a real estate professional? If so, can he claim the loss from his long-term rental against 150 of active income? The answer here is yes, he can. He's a full-time real estate professional. That's the first fact pattern to look at. He also self-manages his property and materially participates with those hours. And he has a loss, so that loss can now offset that 150, bringing his income down to 130 grand. So again, not going to dive too deep into this, but reps hours, again, we kind of went over the hours. You have to spend at least 750 personal hours and you have to materially participate. Hours that count towards rep status is, if you own a real estate practice or you're in one of the businesses, you're good to go. Managing your own short-term rentals do not qualify, and you cannot aggregate hours with a spouse. So like if you work 700 hours as a real estate professional and your spouse did advertising for something for 50 hours, you guys can't combine your hours to get that 750 personal service hours. And then what hours qualify for material participation on each of your properties? Generally, I like to tell people try and think of anything you do to the property that impacts the performance or maintenance. So, showing it, screening tenants, renovations, repairs, upkeep, cleanings, all that qualifies for it. Like if you're trying to do bookkeeping or education is the biggest one I see. Training, education, those hours do not count at all for really anything. Um, yeah, the IRS loves flagging people that try and claim reps with W-2s. Okay, final topic, expense, or maybe we have one more after this. Can't remember. Expense it or capitalize it. Again, going back to depreciation and that code section being so robust, a part of that tells you what you have to capitalize and depreciate versus what you can immediately expense day one. Examples of improvements that you generally need to capitalize and depreciate over an applicable life is right here on the left. Um, some of this is misleading because there are certain elections you can put into place to circumvent having to capitalize and depreciate. So if you're working with a CPA, if they, know what they're talking about, they can see into your books, or they should be able to look at your books and record keeping, maybe ask a couple questions, and a good one will pull items out of the capitalization bucket and over to the expense bucket. Um, so I'll let you like some common expense deductions that are just real easy are all listed here. Software fees if you're running tenant background checks, phone, internet, computer utilities. Yeah, if you pay a CPA to do your tax return, and the primary reason is because you have rental property, those accounting fees and bookkeeping tax fees could be deductible. So here's just kind of an overview. Expenses are nice because you get them day one. You do not have to track them over the asset's life, and you don't even have to deal with depreciation recapture when you sell the property. Capitalizing assets, you have to track it, you have to depreciate it, and then you have to consider that depreciation recapture component once you go to sell the asset. If it's, let's say it's a house and you have an HVAC component, repair or replacement, let's call it, in year three, you're going to have to tack that onto your depreciation schedule and have your CPA make sure you're picking that up every year. This is kind of just a Schedule E. So I like to tack this on here because it shows you where your rental real estate is going to go. And I highlighted some of the line items you should almost always see as a deduction. These four right here, if you have a mortgage and if you own the property, these should always be populated. And of course, rental income up here should be populated. So Schedule E is generally speaking where rental real estate goes. Hopefully I didn't go okay. 628. Yeah, that was high level rental real estate. I could go on forever about all the nuances of it, but that's a good starting point for if you're in real estate and you're not too attuned to it, or if you're just getting into real estate, is a great place to just dip your toes in, to just listen to this presentation. It kind of touches on a lot of topics, high level. That QR code should take you to my website. I don't think it'll take you anywhere else, and I'm sorry if it does. Uh, Next presentation is Monday, December 8th. We're going to dive deeper into tax depreciation and the advantages there. Um, this is one of the best planning strategies right here is depreciation. We do real estate for tax purposes to get losses to offset your W-2, and depreciation is how you do that, generally speaking. But yeah, Eric, I think, I hit that 30-minute
Yeah,
limit, and we
yeah,
can
that was
open it up
great.
to any Q&A, or if you have any closing comments before that.
No, I think, well, the only thing is, that's all asked about the recording. I'll be probably putting it up on YouTube and I'll send you everyone a link for the recording for today, so you can go back and review it. But thanks, Kevin, for giving us kind of a high level, for tax strategies with real estate and looking forward to the next one. But now we'll open it up. If anybody has questions, please, yeah, shoot them out and let's hear them. Well, I'll start because I have a question, Kevin, for you. So you mentioned the recapture once you use depreciation on a property, but say you sell it in 3 years, you then there's like that recapture and you might have to pay for that. Uh,
Yeah.
is there a strategy that you recommend to your clients to avoid that recapture, or is it just, hey, if you plan on selling in 3 years, this is what will happen, and that's just kind of how it is. Is there any strategy to avoid that?
Yeah, there is a if you can tell if you one of the big strategies I like to talk about is taking depreciation day one, right? The idea if you're doing that, you're gonna decrease your let's call it your W-2 income, and your W-2 automatically withholds taxes. So you're gonna get a larger refund on that return if you're taking your W-2 and squashing it with a bunch of real estate losses if you're able to do that. The the where so you're getting kind of a loan from the IRS via depreciation. In 3 years, you go to sell that property. The big like tax strategy around that is you kind of have 3 years to work into that that tax year to where you can plan around being in a larger tax bracket. So like one real life example I had is one taxpayer did a cost, we'll get into this later, a cost segregation study, took a lot of depreciation year one, and they knew they were selling the property in 3 years. And I kind of said, hey, if you know you're selling the property, you're going to pay to do the cost seg. You do have a time value of money factor here. If you're going to put that money to work, great, do it. If not, it's kind of a loan from the IRS. You're going to have this recapture probably in a later year at your ordinary tax rates. And she said, that's great and all, but this current year that she's in was her highest income year and will be. She was in the highest tax bracket. And I said, okay, that changes everything. And she told me in 2 to 3 years, she will be working part time slash not working. So I said, hey, let's do this thing. Let's juice up your depreciation this year. We're going to take you from the highest tax bracket down to a much lower tax bracket. When you sell the property in a later year, in year three, when you're working part time, you're already at a much lower tax bracket. You're going to pick up this gain at ordinary rates. Yes, there's no way, there's really, if everything kind of stays the same, there's no way around that. But it's going to be at much lower rates that you're paying taxes on than in year one when you got that huge benefit. So there's a little bit of arbitrage here that you can play with in terms of timing.
Cool.
That
That
kind of
makes
makes
sense.
sense. Yeah.
Yeah. Yep. What if you do a 1031 exchange? Would that offset it?
Yeah, if you do a 1031, you're just delaying, right?
Yeah, you're
You're
keeping delaying it.
pick
Okay.
up. Yeah, you're pushing off that
Yep.
gain recognition further and further until one day you decide not to do a 1031 and you just sell outright. Then it kind of all comes due.
Cool. Awesome. What other questions are there?
Everyone understood all that. That was impressive.
Come on, Luke. I know you have one.
Not yet. All right. Well, Luke, we'll look for you on the next presentation, and Eric will probably call you out again.
That's right. Well, cool. Well, if no one has any questions, then we'll just end early. we'll have our next one, like Kevin said, next Monday, same time, same link. You should have it in your calendar. If you don't, let me know. Happy to send you the link. Well, I'll be sending it the day before, anyways, and we'll dive into depreciation. And
Yeah.
if there's no other questions, we'll move on. Everyone have a good night. Hope you had a great Thanksgiving as well.
Yeah.
Thanks. Bye.
Thanks.